All right, I want you to think about something. You make under $100,000 a year. Maybe you're at 45,000, maybe 72,000. Maybe you just cracked 90,000 and you feel like you're finally getting somewhere. And every year you file your taxes and you think, I don't make enough to do any real tax planning. That's for rich people. That's for the people with accountants and LLCs and complicated situations. So you file the standard deduction and you move on. Here's what I want to ask you. Who told you that? Because the people who benefit most, and I mean most, from knowing the tax code are not the people making $500,000 a year. You benefit as well from lowering the taxes you do pay, even if it's $1. And the IRS is not going to call you and say, hey, you missed something. So today, I'm going to do it. If you make under $100,000, here is exactly what you need to do to keep more of what you earn. Number one is to take the standard deduction, but know when to switch. Let me explain something that most people get backwards. The standard deduction exists to make filing simple, right? In 2026, it's $16,100 for a single filer, $32,200 for married filing jointly. So you take that number and it comes off your taxable income. Easy, done. And for most people under $100,000, that's the right move because you can't beat it. But here's the question you need to ask. Can you? With mortgage interest, state and local taxes up to the SALT cap, charitable contributions, significant medical expenses over 7.5% of your income. If those numbers added together exceed your standard deduction, then you itemize and you save even more money on taxes. But the problem is that most people never run the math. They just click the standard deduction because that's what the software defaults to, or that's what their tax preparer defaults to. But run the math every single year, because the year you buy a house, the year you have a major medical expense, the year you give significantly to charity, that might be the year that itemizing saves you thousands of dollars in taxes. Don't default to the standard deduction. Run the numbers on standard versus itemization. Now, number two is to contribute to a traditional IRA or 401k, like right now. This one is simple, and the fact that most people under $100,000 are not maxing this out genuinely baffles me. Here's what's happening. Every dollar you put into a traditional IRA or a 401k comes off your taxable income, dollar for dollar. So you make $75,000, you contribute $7,500 to a traditional IRA, the 2026 annual limit, and now the IRS only sees $67,500. You just made $7,500 invisible. And guess what? It compounds, tax deferred for decades. Now some of you are saying, Keran, I can't afford to max it out. Okay, then contribute something, $50 a month, $100 a month. Get in the habit and increase it every time you get a raise, because the tax break is immediate and the compounding is long term. And if your employer offers a 401k match, listen to me very carefully. That is free money. Free. The 2026 401k limit is $24,500. If your employer matches 3% and you're not contributing at least 3%, you are leaving part of your compensation on the table every single paycheck. And by the way, if you want the master list of tax credits, deductions, strategies that the best CPAs use but don't tell the public, head to keepmost.com. There are over 90 of them that you can use to lower your taxes today. Number three is to open an HSA and actually use it. If you have a high deductible health plan, and a lot of people under $100,000 do because the premiums are usually lower, you qualify for a health savings account. And I need you to understand what an HSA actually is, because most people treat it like a checking account for doctor bills. It's not. It's the only triple tax advantage account in the entire tax code. You contribute pre-tax deduction. It grows tax free. You pull out for medical expenses tax free. 3 opportunities for the government to take something from you, and 3 times you said no. Now the 2026 contribution limit is $4,400 for individuals, $8,750 for families. And here's the thing that a lot of people miss. You don't have to spend the money. You can invest that balance, index funds, ETFs, and let it grow for decades. Pay your medical bills out of your pocket today if you can swing it. But just keep the receipts, and years from now, you can reimburse yourself from the HSA tax-free for expenses you paid back in 2026. And the good news is that there's no time limit on reimbursement. That's a tax-free investment account hiding inside a healthcare benefit. So you should open it, fund it, and invest it. All right, number 4 is to claim every credit you qualify for. Remember what we said about credits, not deductions, credits. A deduction reduces your taxable income. A credit reduces your actual tax bill, dollar for dollar. And if you're making under $100,000, there are credits sitting in the tax code right now with your name on it. You have the earned income tax credit. If you're a lower to moderate income earner, especially with kids, this credit can be worth thousands. And you heard that correctly, not hundreds, thousands. And it's refundable, meaning if it exceeds what you owe, the IRS sends you a check. The child tax credit, right? Up to $2,200 per qualifying child in 2026, partially refundable. And we can't forget about the savers credit. You contributed to a retirement account, there's a credit for that. It's up to $1,000 for single filers, $2,000 for married. And for 2026, the income limit for singles is $40,250. For married filing, just double it. And if you're under those numbers and not claiming this, you're leaving money on the table. Then there's the American Opportunity Credit or Lifetime Learning Credit if you're paying for education. Now, here's what gets me, because these credits are not obscure, they're not hidden, they're right on the IRS's website. But people miss them because they're clicking through tax software at 11 p.m. on April 14th, and they're just trying to finish, just trying to file. Slow down. You need to go through every single credit, every single one, and one credit you missed could be the difference between owing and getting a refund. So that's where keepmost.com comes into handy. Number 5 is to start a side hustle and run it like a business. This one is for people who have any kind of income outside of their W-2. And if you don't, you likely should. Freelancing, consulting, selling on Etsy, driving for DoorDash, mowing lawns on the weekends. Whatever it is, the moment you have self-employment income, you have access to a completely different set of deductions. And most people with side income have no idea. Your phone, partially deductible if you use it for business. Your home office, deductible if you have a dedicated space used regularly and exclusively for work. Equipment, software, subscriptions related to work, deductible. Mileage driven for business purposes, deductible at the IRS standard rate. Oh, and let's not forget about the big one, a SEP IRA or a solo 401k. If you have self-employment income, you can open one of these and contribute a significant portion of that income pre-tax directly into a retirement account. SEP IRA lets you put in up to 25% of net self-employment income. Solo 401k has even more flexibility. You are not just a W-2 employee anymore, you are a business. So start running it like one. Track everything. Separate business account, separate credit card. Because when April comes and you've tracked every dollar, those deductions are real. They're documented and they come right off the top. Now, number 6 is to adjust your withholding. Stop giving the IRS a free loan. You see this one right here, this one actually bothers me every time I think about it, because the average tax refund in America is over $3,000 and people celebrate that. They post about it. They plan vacations around it. But you know what a $3,000 refund actually is? It's proof that you overpaid the government by $250 a month all year. And they held your money and didn't pay you any interest. You gave them a loan interest free. And they gave it back to you in April like they did you a favor. So go to your HR department, fill out a new W-4, adjust your withholding so that you're closer to breaking even at tax time. And take that $250 a month right now, today, and put it into your IRA, your HSA, your emergency fund. That money working for you all year is worth more than a lump sum in April. Look, that refund, it feels good. I understand that. But feeling good and building wealth are not always the same thing. Number 7 is to file correctly. Your status, your filing status changes everything. And this one is simple, but the mistake is costly here. Your filing status, single, married filing jointly, married filing separately, head of household. These statuses determine your tax bracket, your standard deduction, your eligibility for credits. And believe it or not, people get it wrong every year. Head of household is one of the most commonly missed. If you are unmarried, you paid more than half the cost of keeping up a home, and you have a qualifying dependent, you do not file as single. you file as head of household. Because in 2026, right, the standard deduction jumps from $16,100 to $24,150. That bracket is wider. You pay less by going head of household. So the difference between filing single and head of household on a $70,000 income can be $1,000 to $1,500 or more. And if you're married, run both scenarios, jointly and separately. Most of the time, jointly will win, but not always. High medical expenses, student loan repayment plans, certain income situations. Sometimes, separate is actually better. Most people pick a status, never question it, and file the same way every single year. But I want you to question it every single year. The truth is, you do not need to make $500,000 to have a tax strategy. The people who build real wealth at every income level, $45,000, $75,000, $95,000, they're not smarter than you. They are not even luckier than you. They just learned the tax code is not something that happens to you. It's something you can learn to work with. Look, if you want the master list of tax credits, deductions, strategies that the best CPAs use, but don't tell the public, head to keepmost.com. There are over 90 of them you can use to lower your taxes today. So I hope you enjoyed the video. My name is Keran. I'll see you in the next one. Take care.